Let's go ahead and walk through these example problems together and discuss them, and hopefully this will help you apply some of the concepts you're learning. For this first exercise we are looking at some selected transactions for this lawn care company. Our instructions are to describe the effect of each of these business transactions on the company's assets, liabilities, and owner's equity. Okay, so looking at the first one, made cash investment to start the business. So the owner invested cash into the business to get it started. The impact on this from the business's perspective is that it received cash. Cash is an asset to the company, so the company's assets must have increased. So there is an increase in the assets. Remember, every transaction will always affect at least two accounts. That's the only way our accounting equation will stay in business. Thus, if the assets increased, something else had to have happened. Some other account was affected. Assets increased, cash increased. It increased because the owner invested in the business. When an owner invests in the business, the owner investments increase, causing owner's equity to go up. So there's an increase in the assets and an increase in owner's equity. Paid monthly rent. The company paid rent. They paid something, they used some of their assets to pay it, presumably cash. Thus, there was a decrease in their assets. Something else had to have happened. When they paid the monthly rent, the payment was made for a cost of doing the business, an expense. Thus, they paid an expense, rent expense. As a company pays their expenses, incurs expenses, it will cause their expenses to go up. As expenses increase, they cause a decrease in owner's equity. Purchased equipment on account. The company purchased equipment on account, meaning they haven't paid for that purchase yet. They purchased an equipment, which is an asset. There's an increase in the assets. If they bought it on account, they haven't paid for it, that means their liabilities have increased. So there is an increase in the liabilities. Billed customers for services performed. We billed customers because we provided a service for them, or the company provided a service for them. That means customers received the service, but they haven't paid for it yet. They just were billed. They have not paid, which means the company is owed money by the customer. That is an account receivable, amounts owed to the company from customers who haven't yet paid. Accounts receivable represent amounts that will be received in the future. They are assets to the company. Thus, customers owe the company more, their assets are increasing. So there is an increase in the assets. Customers owe more because services were performed. The company has provided the services, they have earned the revenue. Even though they haven't been paid for that revenue yet, they have still earned it, and they record revenues when earned. That means revenues were earned, revenues increase owner's equity. More revenues were earned, there was an increase in owner's equity. Withdrew cash for the owner's personal use. The owner took cash out of the business for their own personal use. That means some of the company's cash decreased. Cash is an asset. There was a decrease in their assets. When an owner withdraws some of their investment in the company, the owner drawings have gone up. The owner has withdrawn more. As the owner's drawings or the owner's withdrawals increase, they cause a decrease in owner's equity. Some of the owner investments have been taken out of the business. We received cash from customers billed, back up here in number 4. Remember, up in 4, we billed customers for services performed. They have now paid us the amounts that we billed them. We have received cash, which is an asset. We have more cash in the business, so the business's cash increased. The reason we received that cash was because customers paid amounts they owed to us. That means our accounts receivable have now gone down. The customers no longer owe the amounts to the company. Accounts receivable, remember, were an asset, and we increased the assets back when we billed them. Now that accounts receivable is decreasing. So in this transaction, we affected an increase in assets for cash going up. We also decreased assets because the accounts receivable decreased. Notice that in number 6, we did not record revenues being earned. Revenues were not earned here. The only thing that happened was the customers paid us for revenues that we had earned previously. We can't record revenues again because we would be double recording the revenues. Number 7, we incurred advertising expense on account. We incurred the expense on account. We haven't paid. Expenses have increased. As expenses increase, owner's equity goes down. On account means we haven't paid for that advertising expense. If we haven't paid, it means our liabilities have gone up. There is an increase in our liabilities. Liabilities increased, owner's equity decreased. We purchased additional equipment for cash. We bought equipment and paid for it right away. More equipment. Equipment is an asset. There's an increase in the assets. We used cash. Cash decreased. Increase in assets for the equipment we bought. Decrease in assets for the cash paid. Finally, we received cash from customers when the service was performed. Received cash, which means our increase in cash, increase in assets, when the service was performed. Customers paid us as soon as we provided the service. That means we have provided the service and we have earned the revenue. Revenues have gone up. As revenues go up, cause owner's equity to increase. We can see the impact of those down here on the equation. Notice that for every one of these, we keep this equation in balance. Assets will always equal the liabilities plus the owner's equity. That's the only way this equation will stay in balance. Okay? Okay, moving on, let's try another exercise. Here, Brandon Computer Timeshare Company entered into the following transactions during the month of May 2010. What we're going to be doing is indicating we're going to match these transactions to the appropriate description here as to whether there's an increase in assets, decrease in assets, so on and so forth. So, purchasing computer terminals for $20,000 from a supplier, digital equipment, and those were purchased on account. Computer terminals are going to be an asset for the company. Thus, we know assets are increasing, and if we bought them on account, we haven't paid for yet. It means our liabilities are increasing. Going down here, it looks like we have an increase in assets for the purchase of the equipment, and we have an increase in liabilities for the fact that we now owe more. So the answer to number 1 is C. That's the correct description. Second one, we paid $4,000 cash for May rent on storage space. We know that cash was paid, means our assets decreased, so we have a decrease in assets. We paid May rent. Rent is a cost. It's an expense of doing business. That means our expenses go up. As our expenses increase, they cause owner's equity to go down. So we have a decrease in assets. We also have a decrease in owner's equity. So the answer to this one would be D. 3, we received $15,000 cash from customers for contracts billed in April. We received cash. That means our assets have increased. And for contracts that we billed in April, that means we had previously billed the customers because we're now in May, which means when we bill the customers, we must have had an account receivable recorded in the accounting system from them. Those customers are now paying us for those previously recorded accounts receivable. So our assets went up when we received cash, and our assets decreased when the accounts receivable was received. It was paid off. We no longer owed those accounts receivable. So for number 3, we have both A decrease in assets, and we also have, well, let's see, I'm not seeing the answer. Oh, here it is, an increase in assets and a decrease in assets. So the answer to that one is A. Let's see, we provided computer services to this construction company for $3,000 cash. We provided services. We have earned a revenue. As soon as we provide the service, provide the customer what it is that they are wanting, we have earned a revenue. Thus, we have an increase to our revenues, an increase to owner's equity, and they paid us right away. So our assets increased as well. We have an increase in our assets and an increase in owner's equity. The answer to that one would be B. 5, we paid Northern States Power $11,000 cash for energy usage in May. We paid cash for energy that we use. That means we paid an electric bill. Cash decreased because we used it to pay the bill. And if we're paying our electric bill, we're paying our cost or our expense. So we will record an increase to our expenses, which cause our owner's equity to decrease. So we have a decrease in our assets and a decrease in owner's equity. Brandon invested an additional $32,000 in the business. The business received cash. Cash is an asset. Assets are increasing. Owner invested. Owner's equity is increasing as well. So we have an increase in assets and an increase in owner's equity. We paid digital equipment for the terminals that we purchased up in number 1. Remember back in number 1 when we purchased that equipment, we recorded an increase to our liabilities. We are now paying that liability. So in number 7, we are going to be decreasing our assets because we're using cash to pay off the debt. There will be a decrease in our assets, and we are paying off the liability that we had previously recorded. We are not buying more equipment here, we're just paying the debt. We're paying off the liability. That means assets decreased and liabilities decreased as well. Finally, in number 8, oops, I'm sorry, I didn't mean to do that. Number 8, we incurred advertising expense for the month, $1,200 on account. We incurred an expense. Expenses have gone up, causing owner's equity to decrease. That advertising expense has not yet been paid because we incurred it on account, which means our liabilities went up as well. Thus, there was an increase in our liabilities because we now owe for that advertising expense, and a decrease in owner's equity because we've incurred the expense. Notice that we record the expense as soon as it's incurred. We don't necessarily wait for it to be paid. Record revenues when they are earned, and record expenses when they are incurred. Continuing on, let's look at another exercise related to Chapter 1 concepts. This problem is going to have us kind of trying to recalculate certain things, essentially net income for the company over these 3 years. What we are given here is for the 3 years of 2009, 10, and 11, the total assets and the total liabilities for this company. Now remember, the basic accounting equation says assets will always equal liabilities plus owner's equity. We are not given owner's equity here, but we can figure out the total owner's equity by the sole fact that we have 2 parts of a 3-part equation. Okay, keep that in mind. This company, Lilly, began business on January 1st, 2009 with an investment of $100,000. Okay, so that means that on January 1st of 2009, the company started off with an investment owner's equity of $100,000 and probably cash of $100,000. At the end of 2009, this company had total assets of $400,000 and total liabilities of $250,000. The first thing they want us to do is to compute net income or loss for the year 2009, assuming that Lilly, the owner, drawings or withdrawals for the year were $15,000. Okay, going over here, let's take